On today's show, 3 questions. Number 1, are we headed into the red? Number 2, does it matter if you beat the S&P 500? And number 3, are 401ks a scam? Welcome to Dentist Advisors. Let's start that over. Welcome to Dentist Money's 2 cents, where we have dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Guys, it's a rough one today. It's a rough one. We started off we've been fiddling and fuddling for about 30 minutes. You'd think we have not done this for years, but here we are. We made it. It's on days like this that you get better. That's what they say, right? And Jake, you're not joining Rabih and I on the hat crew. We're a little sad about that.
Letting the hair show today. Yeah.
Hair's looking great. Let's jump in.
Honestly, if I could pull Jake's hairstyle, I would not wear a hat either. But
that is nice.
Rabih,
nice.
I don't want this to be offensive, but I think you'd probably say if you could pull any hairstyle.
Any hairstyle. Here you go. Don't get blinded by the reflection.
I can only to you and Ryan. Okay, number 1, Rabih, are we headed into the red?
Yes.
Oh no,
scary.
Or no. Actually, this is interesting. This might be the first time in 2025 where we talk economics and data that's coming in and not focus on tariffs. Consumer sentiment has been changing. This is the big, headline. And I really want to take a deep dive to see, is that all, or is there anything else changing? The market has been, if I want to quote it, unsexy for the last 6 months. Since October, it really did not move. Talking about the S&P 500, like if you've put your money in October, you've seen them go up and go down so much. But if you look at them now, there hasn't really been any change. And this is creating some, cognitive dissonance amongst investors. Some of them want it to rally up. They are annoyed by the uncertainty and they just want to get to a new stage where they know whether we're going up or we're going down. And in terms of like the mindset and what the market participants are talking about, it seems like they're expecting a sell-off because there's uncertainty regarding fiscal policy going forward, especially tariffs. And then the economy is, put in its place. So I got a bunch of stuff to report on. We got unemployment to report on, consumer confidence, inflation, as well as earnings. So let's start with earnings because it's interesting and it kind of shows us a shift in the regime for a little bit. We just concluded the earnings season. Nvidia reported its earning end of this week, and it's usually at the end of the earnings season. And as usual, Nvidia beat market expectations amazingly on Wednesday.
Keeps happening, just keeps charging.
But yesterday, the stock price slashed 8% down. The whole, regime where Nvidia amazingly beats earning and then it rallies plus 10% to 25% in the week after has really been diffusing away. We saw it in the previous quarter for Q3 2024, now for Q4 2024 earnings. It seems like the market knew that they got ahead of themselves with the Nvidia valuation. It was valued above 3 trillion, now it dropped below that. It was the second largest company in the US according to market valuation, but it really did not reflect that in the revenue yet. It only reflects it in revenue growth. So it's interesting that just the AI story, the chips story, the Nvidia story is now not the main driver for the market. And it's very logical because a tariff narrative is larger and contains a story about a single company. So let's talk consumer confidence because I think that was the most important one and the one the market has been paying attention to the most. Just to give you some background, the consumer confidence is an indicator where if it is above a value of 100, we say that people are optimistic. And if it's below a value of 100, people are pessimistic. It's a point in the markets where fear might start showing up. The previous print was 105.3. And it's been above 100 for probably since 2023. It's been above 100 since the Fed decided to stop raising interest rates. And then the consensus and forecast for what this print is going to be for February was between 102.5 and 103. Data came in, the print, at 98.3. So not only below consensus, also below the 100. So in terms of And consumer confidence, that is showing low. What does this mean in economics terms? It means that those consumers who have been spending their way into a strong, healthy economy for the last 2 years, they are losing confidence. It doesn't mean that they don't have money anymore because they got fired, or they don't have money anymore because inflation is running rampant. No, it's just their confidence, given like the narrative, the rhetoric, etc. out there.
Yeah, Jake's going to say the same thing. Go ahead, Jake.
Well, I was just going to say why. Like, it's interesting to me that people are changing to more of a negative point of view when what has materially changed in our economic, in our economy. I'm curious on why people are like, yeah, you know what? I feel like a recession's coming.
I just think this narrative, that's what I was going to say, the narrative build, it's kind of interesting. Speaking of, I don't know, Rob, if you're going to get to this as part, but I think it's pertinent to this. I think it's today. Have you guys heard of this whole like spending freeze today? Have you guys heard this? There's like this some social media thing. I'm not even into social media, but I've seen a couple of things. People are out there like trying to rally the troops of like, don't spend today or something like this.
It's like a no spend day.
Well, they're trying to like, I believe it's quite political. I think so. We're going to get real, we're going to get polarizing here, but I think there's this, people are trying to rally each other around like, don't spend today, like let's shut down the economy situation. That's what I've been seeing a little bit of. Rabih, you look like you're onto something.
I'm looking on my economics dashboard, like for breaking news. It didn't make it there yet. I think it's still in the realm of politics so far.
Yeah, it's probably a social media politics thing that I saw a couple of comments on.
That's interesting though, because that goes completely against what the textbook tells us about growing the economy. We need to be spending.
I think it'll
be very interesting to see how that pans out. All right, so let's actually look at inflation.
But I mean, this is so interesting. Just on this, like, okay, so consumer sentiment is down from what it has been in the past for no real reason other than people just guessing or assuming or reading a scary news article. I just find that funny. It actually, me and my personality, that actually makes me more confident about this year.
Okay, I found it. I found it for you. This is No Spend Friday, February 28th. It's a protest that alleges businesses are taking advantage of American spending power with prices that are too high. One comment said, for one day, we show them who really holds the power. Sure you will. This is also part of, so February 28th, No Spend Day, boycotts major retailers, banks, and gas. Good thing I filled up yesterday. The move for National No Spend Day comes after several corporations rolled out their diversity, equity, and inclusion policies amid President Donald Trump's call to end federal DEI programs and threaten tariffs on international imports.
Yeah.
So I was not crazy. This is something. People are out there trying to rally.
I agree with the sentiment. I mean, I agree with, I think, the motion here. I've always said, like, as people are complaining about inflation, like, rather than being mad at the government or different places, like, I would just be mad at the corporations. They're the one raising the prices on you. And the reason they're raising their prices is because you keep buying it. They can. Yeah. It's like, this is just capitalism. Like, they're raising the price of things because you keep paying for it. And so, yeah, I agree with the sentiment of, like, eventually they're, the buck comes, I don't know what's the term, whatever. The buck stops with you, like, you have to start buying this stuff. But anyway, I agree with the sentiment, but it's like, yeah, we still, like, today's not going to likely do anything, and people will still just keep buying the stuff they've been always.
Yeah. Sorry, Rabih. We went off the rails there for a second, but I thought it was pertinent because I saw a couple of comments, and I think it is pertinent with this topic of we are literally talking on the day of people trying to say No Spend Friday. We'll see if it moves the needle at all.
Have you guys spent any money so far today?
No,
not today. No,
so you're participating.
So we're good. We're actually fine. I plan on spending money today. Friday's usually my eat out day for lunch. Okay. So I'll probably eat out for lunch. It'll probably be Chipotle. I'm just gonna be honest with you right now. I will just say it. But maybe I'll just make a PB&J at home now, and I'll be for solidarity for the people. Yeah, exactly. Yeah. So Rabih, back to you in the studio.
Yes. So the other stuff are just data points that confirm what you guys are saying, that really not much has been changing in the economy. So all of these happened this week. We got today this PCE, and it came at the 3.3, 2.3 or 3.3?
2.3 feels low. Is it 3.3?
Oh, no. 2.5, 0.3 month to month. I knew there was a 3 somewhere. Excuse me. So it's 0.3 month to month. This was what it was the previous month. This was what the consensus is for this month. And this is what it came at. So in terms of inflation, the trend that we have priced in prices still is showing as we expected. GDP, the second revision of Q1 came in, which we knew of. It came in for Q4 not Q1, at 2.3%. And their second revision did not change that. We're still at 2.3% for how Q4 grew. And then we got initial jobless claims, which this is an interesting one, but it's very, very, very noisy. Initial jobless claims are a weekly data point that tells us how many people filed for unemployment. And last week, the week of February 17th, we were at 225,000 people. The expectations for this week were 220,000 people. It came in at 242,000 people. So you're talking about 22,000 people more than they were expecting, which if you look at the data, it's just like a little bit of a jump that more people got fired that week. But in terms of the range that it's been fluctuating at, it's still very normal. A lot of people were making jokes like those are the people who Doge fired, those 22.
Yeah, I wonder how that impacts unemployment stuff. Like if there's a catalyst with all these government employees being laid off, does that lead to
it might, but it's been fluctuating between the 200K a week to 260K a week. And this is just in that range. Just because there are jumps in between it doesn't make sense. Also, it gets more complicated because you could get fired today, but you are on some severance or whatever that prevents you from filing unemployment for a couple of months or weeks. So there's a mismatch between when those stuff show up. But like so far, in terms of where the economy stands, GDP is what we know it at, 0.3 for Q4, around 2.8% for the whole year. We got unemployment in check, just still, hovering around the 4% level that we're in. We've got inflation at the 0.3% month over month at the PCE level. Nothing new has happened except the narrative. And it comes with, some uncertainty. I don't even need to talk about it. Everyone knows that there's uncertainty. You've got problems with tariffs, negotiation with new countries. There's our wars around the world that are trying to be disputed and resolved. So that thing will actually have an effect on consumer sentiment. The only problem that this might lead is if businesses decide to hold down investment until they figure out whether the consumer is going to spend or not. So usually when consumer confidence is high, businesses would double down, add more investments, which is a part that grows the GDP. And they would provide the supplies so they can capitalize on this high consumer confidence, aka aggregate demand. If, consumer confidence stays low for a prolonged period of time, that would be an indicator for businesses not to invest ahead of time. And that would make it a self-fulfilling prophecy, aka
that's what I was gonna say. Like, is this become a self-fulfilling thing where consumers are like, I'm worried about the rest of this year, how the economy is going to go, so let's stop spending, let's start buckling down. Businesses do the same thing. Then all of a sudden, this eventually does
what they're fearing.
What they're fearing.
Exactly.
It's interesting. Yeah.
We've talked about this before, Rabih, around recessions. A lot of times, the narrative around recessions can cause recessions because of this exact thing.
Yeah.
100%. But so far, it doesn't look like it. Like it'll take a lot of steps. Right now, we're seeing businesses in their earnings season saying that, profits are great, revenue is great, we're beating estimates, but our outlook is that we have a weaker consumer going forward. But not too weak that it's creating problems. Some companies have laid off a bunch of employees, especially in the tech sector, but it's mostly for cost restructuring rather than a cyclical trend that, we're heading in a different direction.
Rabih, did you say 100 is the kind of the line in the sand for the consumer sentiment indicator?
Yeah. 100 means neutral. Above 100 is optimistic. Good. Below 100 is pessimistic.
Got it. I'm just curious, and I'm putting you on the spot, so please tell me to shut up if you need to. Do we have like historical markers for recessions? Like where were we? I just want to give some relative or some benchmarks of like, okay, we're 98 right now. Where were we like 08, 09? Where were we last recession or when the market was down in 2022? I'm just curious kind of where the benchmarks are there.
Yeah, I have it actually. You guys can fill the air for 30 seconds until I get you the data.
Well, I'm wondering if it's something where if it's is the consumer sentiment low as we head into recession, or is it the opposite? It's actually really high, and then there's a freak event that causes it to plummet.
Like recency
I'm curious.
bias. Exactly.
Yeah, I'm curious on what.
All right.
I got that point.
Are you guys ready to look at them?
Let's hear it.
Okay, so let's look At June 2022, which was a couple of months before the Federal Reserve decided to stop raising interest rates, if you guys remember at that point, the S&P 500 was down around 18% at that point. The confidence was low. People were like wondering, when is the bottom? Inflation is eating our pockets. This is where we were at that point. Actually, June 2022 is when we got the 9.1% reading on the CPI, and everyone was freaking out. It was at that point. That number, that consumer sentiment index, was at 50. Just to tell you, like, the fluctuation.
There you go.
It was at 50. And then in February 2020, right before COVID happened, where life was still great before, our lives changed, that index was at 100 and 100. And the highest it's been was right before the dot-com bubble, January 2000, it was 112. So that is the range where it really plays. The thing is, nothing has happened in the market since October. So now people are really hyper-focusing on any small fluctuation or a switch in sentiment or number. Jumping from the 102 to a 98 is, making prices slash. And this actually gets us to looking at asset classes and how they've done year to date. Up until last week, the S&P 500 were almost 4.5% up for the year. But now, if we look at them, just to give you some reference, we are negative 0.24. So like less than half a percentage point, but we are negative year to date. We lost all the gain that has been made on the S&P 500. On a globally diversified equity portfolio, it's 1.6% for the year. And this is literally leveraged up or like supported by developed ex-US, because developed ex-US year to date is at 6.25%. So there's already a 6% outperformance, in a sense, 6.5% outperformance between developed and US year to date. Small cap has been hit more than large cap. So S&P is kind of flat. Small cap is down 4% for the year. The biggest performer so far has been gold at 8.38, which is an indicator that the uncertainty is coming from geopolitical stuff rather than economic stuff. And the worst performer, which is very correlated with consumer confidence and sentiment, is Bitcoin, which is down 11.23% for the year. So this is only 2 months out of 12 months of data, but it tells us where the fluctuation has been. It's like, if you're investing just in the S&P because it's flat, this is the equivalent of saying, okay, let's cross these 2 months that just happened and let's start counting what 2025 is going to look like from here forward.
Yeah.
Can I circle back that's awesome. Can I circle back really quickly? Just one more thing on the consumer confidence index. I feel like I'm getting hung up on this, but just one point I wanted to make is, Rob, you said it's really low, about 50, right? In the middle of June 2022, inflation was really high. The stock market's down. People are like, oh, this sucks. The following 2 years were 20+% returns in the market and pretty awesome from that point. And so that's just, I kind of can't help but be like, if the consumer confidence is high, maybe we should be worried. If it's low, maybe that's a time to buy.
Actually, they use it as indicator. And in the data that I have, let me just go back to the same 2 data points that you were mentioning. When we said the consumer confidence interval index was at 50 in June of 2022, the subsequent 12-month S&P 500 return was 17.6%. When the index was at 112 and right before the dot-com bubble, it was, until like it shifted, a negative 2% drop for 12 months after that. Right before COVID, well, COVID is an outlier because the government decided to pump energy.
Yeah, COVID's an anomaly across the board.
It's an anomaly. Yeah. So it was one of these situations where consumer confidence was high, but then the market rallied 30% afterward, just because we did what we did that caused inflation afterwards. Yeah. So it is there, but it is not a perfect indicator, because there is no perfect indicator. But it is more likely than not that instead of saying, oh, I don't know, it's a 50-50, maybe you'd say it's a 52-48, simply because the consumer confidence index can, tilt your attention in one way or another.
Well, and to Jake, I think it's a great point, Jake, because this falls under the category to me of risk tolerance questionnaires. It's just an example of recency bias. It's like, if you ask someone their risk tolerance in 2009, they're gonna, like, let's just say for simple calculations, if you're tell me 1 to 10, Dr. 9 post what happened in 08, 09, they're a 1. they're like, I'm freaked out. I'm freaked out. My risk tolerance is nothing. My risk tolerance is as low as it gets. You ask someone post 2024, back-to-back years of 20% gains, their risk tolerance is a 10. I think it's a similar concept here to consumer sentiment. They're tracking what's happening, right? It's not a shock to me that it's falling. You look at anything online, anywhere, and it's just pure chaos. The narrative is just chaos and fear and all this stuff, for right or for wrong. And we mentioned this on a show a couple of weeks ago where whether you are a Trump person or not, I don't really care. No one can deny that the reaction to him it causes a lot of chaos, right? Whether you are for him or against him, like you're either reacting to him or you're reacting to people who are reacting to him. So I think that has created a lot of this chaos, not to mention again, like him or not, he's making a ton of changes. He is taking a lot of action on things, whether it be Doge or tariffs or geopolitical things. And I think that's creating some chaos coming from from a presidency before him that was relatively chill. Like, let's be real, for the most part, there was not a lot going on. And so I think a lot of this just points to, like you said, Rabih, narrative, geopolitical stuff. Am I off there, Rabih, of saying the consumer sentiment is just probably more of an indication of recency bias and what's happening with the political narrative?
Oh, yeah.
Nailed it. Robbie's like, yes. Okay. Any other thoughts on this at all from the markets, consumer sentiment, anything else, Rabih, you want to cover?
I like to see some foreign developed markets doing well. It's kind of nice.
Diversification for the win. Diversification for the win.
Yeah, very good.
I was thinking the same thing. This actually leads perfectly into the next topic. Look at us transitioning like pros. Does it matter if you beat the S&P 500? So this is not from any article or anything. This is more from personal recent conversations with a lot of our clients. Jake, I'm sure you've experienced this as well. Kind of near the end of last year, beginning of this year, we do a lot of reviews of investments and portfolios. I think it's a natural question, and it's been kind of beaten into us from the financial space. It is just a common thing to say, well, how did I do against the S&P 500? My take on this is, why does it matter? Like it shouldn't matter. But I want to so I'll leave it there. And before I expand on any of this, I want to get your guys' take just straight up. What are your thoughts on it mattering or not mattering whether your portfolio beats the S&P 500?
It's an interesting, my first initial response is no, it doesn't matter, right? Just coming from the point of view of your portfolio and your investments are personal. They are tied to your personal goals. That is what we're working towards. Those things, we're not trying to beat a certain index. However, I do understand, I think the S&P 500 has become like the default, like this is just the baseline. It feels like it's everyone's benchmark, right? Everyone is comparing to it. It has become just that index, right? It's like everyone's like, oh, I can do the S&P 500 or I can do some other things. It's usually a choice between the two. And so I can see why people would compare themselves and their returns to that. Do I think it really matters that we're talking about this is your own money, we're trying to achieve your own personal goals in your life? However we get there, doesn't matter. We're just trying to get there type of thing. So my answer is no, but I understand, I guess, the need and want for people to compare to that.
We have a very, very similar take, Jake. But
on
Rabih,
the fence answer, yeah.
I want to get you in here.
It's also, my take is in the same realm. I'll look at it differently. Do you still care if you're beating the S&P 500 if the S&P 500 is losing 5% every single year? Like the whole idea is you can beat the S&P 500 and break even every single year, but this is not going to take your money anywhere. The goal is, like, the compass isn't the S&P 500. The compass is not to lose money. And not losing money means that on the long run, your money is going to beat inflation. You're not losing money in real terms, and is going to put you in a position where you can achieve your financial goal, whether it is to retire based off this money, to leave it as a legacy, or to do whatever consumption you want to do in your lifetime with it. This is the goal. How you get there, if bonds are giving you 10-11% a year, and those are not an indicator of a very risky government, then bonds might be your way to get there rather than the S&P 500, etc.
Yeah, I think we all share the same sentiment, Jake, to your point. I understand why people default to this. I think it's kind of beaten into us in the financial investing world. It's the one index that mainstream media talks about, CNBC. It's always like comparing it to the S&P, I think I wanted to bring this up because I want to present more nuance to this. And it's what you guys are saying is that everyone out there listening, the goal, the benchmark should be your life. The benchmark should be the progress you're making towards your goals. And if we're really getting into the technicalities, like the S&P is just a portion of a global market. So if you are properly globally diversified, Rabih, you just said it. In 2025, if you're just tracking the S&P and you're not looking at foreign developed, you're not looking at foreign emerging markets, like you're looking at this in a too narrow of a view. Or let's go back to the lost decade. Do you like if you're just tracking the S&P, you're not looking at the fact that foreign markets destroyed the S&P for 10 years. I think it was like 7 or 8% per year, Rabih, right? Something like in that range for that 10-year period where the S&P did nothing. It was the worst decade on record. So I guess I just wanted to bring this up to get people kind of out of this view that, Jake, I agree with you, that it's understandable why you would look at the S&P as like this benchmark. But unless you're a large cap growth portfolio manager, you really shouldn't care what you're doing against the S&P as long as you're making progress towards your goals.
Yeah, I think this has a lot to do with recency bias as well, which we talk about all the time on the show, which is not only is the S&P 500 the most popular index in the world, right? The most popular index funds in the world are S&P 500 index funds. Not only is it most popular and most in the news, it's also probably been the most successful over the past 5 to 8 years, right? So it's this confluence of both of those things where it's just this top of people's minds. Like it's been awesome the past 5 to 8 years, even 10 years. I mean, we can go back. So the last decade has been incredible. And so I think it has a lot to do with it too, where it's just like, this has been, everyone always likes to compare themselves to whatever portion of the market is performing the best at that time.
But so love this, Jake. So my question for people that are out there being like, that we're saying we understand why, but I would say, okay, over the last year, why aren't you tracking gold?
Yeah, that'd be the argument.
Like that's the best performing asset class over the last 12 months, I believe. Rabih, tell me if I'm wrong, but it's again, we can pick and choose what mark we want to use for our performance, but it's arbitrary, I guess is my point. It's completely arbitrary. You can pick and choose, right now it's the S&P, but again, I'd say for 2024, you should have been tracking gold. Maybe you beat the S&P by a point or two, but you got destroyed by gold. So are you a failure? Are you not reaching your goal? I guess that's my point is it gets people into this mindset of success or failure is based on an arbitrary benchmark. And when that becomes the case, I think you kind of lose the script. You're losing the point of what this is all about. Rabih, any thoughts on that?
No, I agree. The script is not to lose money. On the argument for the S&P 500, S&P 500 is, as you said, a subset of the global market, which is large cap growth companies. The economy goes through different cycles, and in some of these cycles, it might not favor large cap growth. It might favor other stuff. And in a cycle where we're coming out of, a recessionary environment, small caps are going to be doing well much more than large caps. Large caps do well at the end, according to textbooks, at the end of those long economic cycles. We kind of avoided, a recession during COVID. We kind of tamed inflation without really putting ourselves into, a swinging up and down with inflation. But in terms of the economic narrative, it's still the strong economy that we inherited post 2008. So this is how long the cycle is. And that's why you would see a certain asset class dominating for a couple of years versus another. So if your investment horizon is 40 years, or even longer, if you have a larger chunk of money, that investment horizon will kind of witness so many different asset classes outperforming at different times. So the whole idea is taking too narrow of a view, just following the S&P 500 might not be in line with a 40-year investment horizon.
Markets work in cycles, right? Nothing works for forever, unfortunately, in the stock market. And so if your goal is, can I be in the highest performing, not even stock, but the highest performing sector of the market every single year, you're likely going to be disappointed because no one can predict and choose that, right? Like you would have needed to be in energy the past year with different things like that. So you're always going to be disappointed, but the good news is you do not need to pick the best performing sector to outperform over time, right?
Exactly.
You don't need to hit a home run every time you step up to the plate to hit. If you can just get on base and be consistent, you're going to win a lot of games and you're going to make a lot of money.
Yep. Love it. We're gonna finish that segment right there. I love that. Let's move on. Last question. Are 401ks a scam, Jake?
Yeah, they are. No, just kidding.
Yeah,
They're not.
easy answer. Easy answer.
Yes,
This is also a big thing on social media, so I'm glad we're talking about this.
yes, it's on social media. You'll always see some clips of people. It's oftentimes comes from the real estate bros. You know who I'm talking about. You know, on social media, we'll try and tag 401ks.
Or they're selling insurance products.
Yes, this is also. Oh yeah, the whole life people and the real estate people really don't love 401ks, and that's okay. This is also top of mind too, as I'm talking with a lot of clients about tax planning. Taxes are coming up and making sure our ducks in a row. So I just wanted to give some general education and kind of address that question head on of like, are they a scam? Are they worth it? Doesn't make sense to do it. Okay. So first things first, one criticism I think I hear people on social media often will say is like, your 401k is a bad investment. I put my money in and I'm not getting a very good return. It's been really bad. And to that, I would say, well, that might be on you. For example, a 401k is not an investment. It is simply an investment account that holds the investments inside of it. So if you are disappointed in your return that you've been getting, maybe you're not in the best investments. You didn't choose the best investments there. Now, I know there's whenever you get into a 401k plan, there are limits to what you can invest in typically, right? They will have like a set of options. There's like 10 to 20 funds that you can invest in. So your options are limited to like opening up a brokerage account at just a normal wirehouse custodian. But if you're disappointed in your investment performance, it is not likely because 401ks are awful. It is because maybe you're in a target date fund that's too conservative for you. Maybe you're all in bonds. Maybe you haven't invested that money in the first place. So you can choose what you invest in to get whatever return you want inside of your 401k.
That's a huge distinction to make. Yeah, because I've heard this so many times over the years. I heard this at Fidelity when I worked there for years. People would be, I'd be talking to people and they'd say, I don't believe in IRAs or I don't believe in 401ks. I've had this one for years and it's done nothing. And then you show them the light. Like, this is just an account type. This is just like having a savings account, just different, different structure to the account. But the growth comes down to how you invest it. So it's like this. I'm so sorry to tell you, but this is on you. You didn't invest it properly to get the returns that you need.
Exactly. So yes, that's the key distinction. A 401k is an account, not an investment. So why you would put money in a 401k, right? The type of account it is we call it a pre-tax account, right? So whenever you put money into a 401k, you get a tax deduction for whatever you put in, right? Let's say you make $100,000 in the year, you put in $10,000 into a 401k. On your taxes that year, you only have to report $90,000 of income. Right. So that's the benefit is you put money in, you get a tax deduction. The money inside of the account grows tax free. And then once you take that money out in retirement, you then have to pay taxes on that money at that point. The reason why this makes sense for a lot of people is oftentimes in retirement, you're going to have a much lower tax rate than you will when you're actively working. Right. About 80% of people in retirement don't pay any taxes. Even if you are in that 20% that will, it's likely to be very lower than if you're in the 25, 30+% tax rates right now. So you're getting a tax benefit up front. You can use that money for different things. There are some stipulations, right? One other complaint that I get about in cases your money is quote unquote locked up, right? Like you can't access that money. And that's somewhat true, right? Which is like you put your money in, you cannot, because you're getting the tax benefit, you have to wait until you're 59 and a half before you can access those funds without paying a 10% penalty and tax on that. So you can access the money if you need to. It's not completely locked up, but you don't really want to. But Matt, to your point, I actually think this is an advantage. This is one of the cool things about 401ks is because it's locked up, it is forcing you to hold on to your money, have a long time horizon, and stay in the market, which is something us investors need a lot of. We need more of a long-term view of these things. And so I would say that's actually an advantage rather than a con. And again, it's not like the government is taking your money. It is not like locked up. You can access it if you really do need to. You can take a loan from it for most plans, but I'd say that's actually probably a pro than a con. Right?
Definitely. It's not a curse. It's definitely a gift that it's locked up.
The last thing I sometimes hear too is people like, well, you put your money in and it's really like meant for your employer and the government's benefiting more than you type of things. I don't quite understand those arguments. I've heard that on a few things there. Yeah, like some people are like, well, the employer only gives you a match to your plan because they are getting to write that off on taxes. And my response to that would be, well, maybe you don't quite understand what a deduction is, right? It's like, yes, if your employer is giving $10,000 worth of match to their employee, they get to write that off, but they are still net negative, right? They're paying $10,000, but saving 20, 30% tax, net negative. You know what they also write off is your salary too, that you're working there, right? Like that's the thing too, but that is not a curse or anything there. So I don't really understand those points of view there. I think it just comes from misunderstanding of what 401ks are, but most of the people I talk to, one of two things, like they know they need to save for retirement. Like most people know that. Another thing that I think most people have in common is they want to save on taxes, right? That's a big deal for a lot of people. And a 401k is an amazing way to do both of those things at the same time. It actually, as I'm going through this with clients and we're talking about how can I lower my taxable income, everyone wants to do that. Most tax strategies involve you to buy something or to give away your money in order to get a tax benefit. You have to like buy a new piece of equipment, you're expanding to a new location, you're buying another real estate property, like you're
Buying a car.
you're
Yeah.
buying a car, you're giving a charity. You have to give away your money to get the small tax benefit. A 401k, while very mainstream and not secretive at all, is one of the only tax strategies where you get to keep your money and get a tax benefit. It is pretty awesome. So anyway, there's my soapbox pitch for 401ks. They are not a scam. They are great.
Jake, I love that. And I want to emphasize that last point. 1K, IRA, HSA are really the only three ways for you to get a deduction and keep the money. Every other scenario where you're getting a deduction, it's a net negative to you. Charitable giving, buying equipment, buying a car, don't do that anyway. Anything like that, you're net negative. People misunderstand tax deductions like crazy. So I'm so glad you brought this up. Let's get Rabih in here, see if he has thoughts on this.
Yeah, I like that you guys really kind of defended and went into the fundamentals for why a 401k is not a scam and it is something really good. And I still wonder, why is it being labeled as such? And I think it's simply because goes against the interests of those people you mentioned, Jake, the real estate people and the whole life insurance people, because it is bad for their business. And that's why they launched a war against the 401k. Because if you sit and look at it from their perspective, their goal is to sell you on a real estate deal or a whole life policy where they can take commission upfront, right? If your money is in a brokerage account and you have an easy access to it, it doesn't take them a lot of convincing to make you get out of a brokerage account and just give them the money. But if the money is in a 401k or an IRA, where if you are younger than 59, not only do you have to go ahead, sell and transfer out, but also pay penalties and fees, etc., it makes it much harder for them to convince you to move into their strategies and make them the commission upfront. And it's, in that sense, from a business perspective, it's much easier to launch a war against 401k to prevent people from having their money there and have it only in a brokerage account than to have to climb the mountain and do 2 stages of convincing. One from a 401k into a brokerage and then brokerage into these deals. God knows what's in them. So that's I think why they call it a scam. It's just a war on the concept because it goes against some people's interests. But what is your interest as an investor?
It's such a good point, Rabih. Find me anyone telling you a 401k is a scam online, and I find you someone who's selling you crap. Like that's exactly what it is. Marketing 101, name your enemy. And that's exactly what they've done. And be as polarizing as you possibly can and be dogmatic. Look at Dave Ramsey. Like nothing against Dave Ramsey. He's a master marketer. He's named his enemy, which is debt. He's very dogmatic in that approach. These people out there selling you crap, and it is absolutely crap. They are the ones telling you, they're incentivized, Rabih, to your point, to tell you 401ks are a scam. It perks your ears up. You're like, wait a second, I know 401ks. I've always been told to do it, to get the match. It's a scam. I'm going to listen. Oh, you're selling me this other thing that sounds fancy. Like it is so easy to see through if you actually start to understand the incentive structure. Truly find me anyone out there that is a prudent financial advisor that knows what they're doing, that's telling you a 401k is a scam. You will find 0% of them. 100% of them are selling you crap. So hopefully that's helpful. Jake, I love this topic. Any other final thoughts? Jake, we'll give you the last word on this topic.
Maybe my last word would just be, apart from people trying to sell you stuff, a lot of the clients we talked were like, well, how can I maximize my tax and things I can do there? I would say the first place you should look if you're wanting to lower your tax bill is just to put money into your 401k. That should be option number one. Above buying a car, above buying a new piece of equipment, above doing anything else, doing a cost-like study on a new real estate property, like max out your 401k first. It is not only low-hanging fruit and easy to do, like we said, it's like the best, like you get to keep your money. And so do that first, and then we can look into different things there. But maybe that's my last word.
Love it. Great last word. Perfect. Rabih, Jake, this is amazing as always. If you're out there listening and you're like, it would be so fun to hang out with these guys and other like-minded dentists.
I know that's what people are thinking.
People are thinking, they're like, these guys are kind of fun. They give us some good information. I need more hours and see their faces. Again, we've always been told, all of us, we have a face for radio. But if you're out there and you're like, I hear their voices, I want to see their faces, I want to shake their hands, you can do that. It's possible. It's possible in June 20th and 21st, the Dentist Money Summit, second annual, whole new slate of speakers. It is going to be amazing. It's going to be so much fun. We'd love to have you out. Tons of like-minded dentists, just like you, listening, share ideas, listen to some amazing, inspiring speakers, lunch and learns for a couple of days. CE credits. It's going to be awesome. So definitely check it out, dentistmoneysummit.com. Rabih, Jake, thank you for being here. Everyone, thank you for listening. That was our 2 cents. Till next time. Bye-bye.